Hello, welcome to my YouTube channel. I am starting a new series specifically focused on option selling. In this series, we will follow a structured approach to understand the price movement and try to generate profits. I will also share my contract notes, and I will try to let you know what I have done and what are my mistakes, and it will definitely going to help me and you also. So these are the basic rules which we are going to follow. The first rule is we are going to focus only on one time frame. For this I have chosen the 5-minute time frame. And for rule number 2, only price actions. We are going to follow the only price actions, no indicators, no external tools. As you can see that there are no indicators, or you can see this, I am using only one indicator, that is 20 bars exponential moving average, but that is it is not used for generating any signals. It is just for me to reference, give a point that the price are above the EMA or below the EMA. So there are no other indicators. Okay. Second, we are going to study candles bar by bar. We are going to analyze the market observing the current price behaviors in relations to previous candles. So we are going to understand each and every candle in detail, what are their behaviors and what are the behaviors with in context with the previous candlesticks. Okay, then this is the most important rule, that is risk and reward ratio. My risk and reward ratio will be 1:3 or 1:4. So I am going to risk 10 rupees or not even 15 rupees. If 10 rupees my risk is hit, I will be out of the trade and I am not going to trade for a second time. If there is a signal bar, then and only. And for the reward, I have kept 35 rupees, but it will be more and it should be more, and it could be increasing or whatever depending on the market. We are not going to exit unless and until there is some movement in the market. Okay, so there can be what you can say, that if the price goes against us and if it hit 10 rupees, and then we are out of the trade. But if my price moves in our direction and if it hits 35 rupees, then we are not going to get out of 35 rupees. We will try to get more reward out of this trade, and we will go and change our stop loss to break even depending on the candlestick. Okay, so this is my rule number 4. Okay, and we are going to take swing tradings when there will be any signal or any pattern we can see, but we are going to trade round about 3 to 4 trades in the whole entire day. So we are not going to take every pattern which we see. Only we will be focusing on the highest probability setups. Okay, now understanding, this is my rule number 5, understanding bull and selling pressure, buying and selling pressure. So every time there is a bull which will try to take the price above and above and above, it will take the price on the upside, and there will be bears who will try to take the price on downside. So we will try to understand the pressure, what are the buyers are doing and what are the sellers are doing. And one thing important that we have to keep in mind, that on every trade there is a buyer and there is a seller, both are involved in the market on every transaction which has been made. Most of the transactions are done by the institutions and the FIIs and all other things. So we have to keep this in mind, and we have to check, or we have to keep on analyzing what are the institutions are trying to do. Okay, so this is my rule number 6. that is trade selection and discipline. So the most important thing which I have learned in my past experience is, it is very much, the important thing is to avoid bad trades in comparison to taking a good trade. Avoiding bad trades is going to protect our capital, so we do not take any trade that are having low probability trades, and completely, and this is the most important thing, we have to completely avoid counter trends. I will try to show you. So we can see that, okay, this is you can see this is a major downtrend. So we'll never ever in our lifetime we will try to judge this movement from low of bar 54 to 60. However lucrative it looks, we are not going to trade this counter trend. Okay, so this is my rule number 6, in which we will never ever trade counter trends. Okay, then we have to avoid predicting the breakouts. Yes, breakout do happens, and many times it comes with a big hefty price, that most of the times it looks like that the price is going to break, and eventually it will break. That is no doubt about it. It will break 20 or 30 times. Out of 10 3 to 4 times it will going to break, but the sixth time it will trap you down. And most of the trades in which if we got trapped out, we will lose a lot of our profit and our energy, and we will definitely, it will break our psychology. So we are not going to predict the breakout, and always we will even after breakout we will wait for the confirmation, and we will focus on the second leg after the breakout. Okay, so we have to pay close attention to the price behavior whenever it breaks the previous high or previous low. So I have got a chart which we are going to study, that is of 1st April 2026, and we will study in detail each and everything. Okay, now our entry and exit. Okay, so when we are going to enter it, okay, when the prices are formed, and there will be a signal bar that will be generated, and we have to enter. If we are going to go long, means if we are going to sell a PE, once the high of a signal bar get hits, we are going to enter long. And for selling CE, if the price hits below of the low bar of the signal bar, we are going to enter. Okay, so these are some of the rules, and in my next videos we will refine all those things. Now let's get back to the chart. So now I have got this. This is the chart. This is the candles of 1st April 2026. Okay, now it has opened a gapped up. So we are, once it is confirmed that it has gone a gapped up, then what are happens, we will see in individual candles. Now let's go to our candles. So I have numbered all the candles, and now we will study each and every candle bar by bar. Okay, now it has been gapped up, and as you can see that after the open is around at this place, it went high. This is the open, and it went high, it went low back to this point, and it closed around this place. Okay, after that there is a bull bar. Okay, now below are the buyers which want to take the price above and above. See, now in this case we know what are the scenarios. So we know that day has been closed, and it is very easy to do the analysis after the day has been closed. But as you can see that after this bar, if you look at, we don't know bar number 55 what is going to happen. We don't know what is going to happen in after bar 52. What will be the bar 53? Okay, we don't know. In this way the price goes on that. So in real market time, making a decision and following our setups is not a tough thing, but it is it kinds of difficult to make a decision to enter into a trade, because anything can happen afterwards. So we have, for that we have got a stop loss to protect our capital. Okay, so let's go over here now. As you can see that bar 3 has broke above the previous high bar, so now this is the breakout. Okay, and as you can see that there are trapped bulls who have bought above the bar 3 are going to get trapped, because they have to, because their stop loss are going to, some of the stop loss are below bar 1. So this is a huge, this is round about 50-60 points which they are going to lose. And as you can see that our stop loss is just 10 rupees. So if we have bought above bar 3, then our stop loss is going to hit anyhow. So we have to keep this into consideration. So as you can see that bar 4 has completely overlapped bar 2 and 3, and the bears wants to take the market down. Now let's see bar number 5. In this bar number 5, bears tried to move the market down, but they were unable to move below the bar 1. Okay, because there were bulls over here, they want to protect their stop loss, because their stop loss were around this place. So there are the bulls who want to take control, and they have tried successfully to take the market above the price above. See, as you can see that bar 6, bar 7 is a huge bar. Then bar 8, see bar 6 there is a wick above it, and over also there is a wick above. Okay, 8. Now all those bears who have sold their position at this place, their stop loss has been hit over here. Okay, and those bulls who have bought at the bar 3, their stop loss has been hit over this place. Okay, now as you can see there is buying, selling, buying. Okay, now once it got above bar 4 high, as you can see that the high of the bar 10 is above bar 4. Okay, now this can be a perfect setup for double top. This is a perfect setup. Now see here bar 9, the price has gone below bar 8. Now this is bar 10, which, so if but this leg has not broke this above bar 4, due to which this is not a leg for which we are looking to have a second leg. Okay, now you can see that this is a perfect double top. So what will be now, our signal bar will be bar 11. So once the price move below this bar 11, we have to short or sell our call. We have to, and just once you entered in this, and our stop loss will be 10 rupees. After that, this, as you can see that the bar has been closed successfully. Now when this bar 13 and 14 forms, it is a clear cut position that we have successfully taken our trade in our direction. Now our stop loss will be around break even. Now let's see, I actually missed this trade and I was little bit upset about not taking this trade, because my views were, because from bar 6 to 10 or by 6 to 10 I thought that price could have gone above, but if I would have taken a trade below this, I would have stopped out at 10 rupees. So I shouldn't be concerned about that, but I couldn't do that, so I was little bit upset for not taking this trade. But anyways, this happens a lot of time. Now let's see, now let's understand what happens after bar 15. Now even the price is above this moving average. Okay, now let's see bar from 15, 16, 17, 18, 19. Okay, the price below 15, the price couldn't got below 15, the price could not got below 16, and yes, there is a price which have gone below. Now the signal bar, this can be this is a low one sell setup, so we have to enter below this. Okay, but as this is a bull bar, so this is not a good signal bar, and as you can see that price went above the low of this bar when it is closed. Now that this, as you can see that this is bar 19, and as you can see that people were sold their positions or have taken a new selling position above the high of 16, 17, 18, and this 19 bar has formed. Now below this 19 bar, yes, I have took a trade and I have sold CE. I will just check what was the time around that. It was around 10:45 that this bar took place. So I sold my position at 10:52, and I sold one position around, and it was the strike was 22,950, and I sold at 253.65. okay, and at 11:04, let's see when it is 11:04, around this position I was what happened, and I thought I should get out of this situation, because as you can see that this is, you can take this as the first leg, and there is a lot of noise over there, and there is a second leg. This is the second leg, so I got out at 11 o'clock and 4 minutes, and I took a considerable profit of around 20 rupees. Okay, but the price went below this, but I was thinking that if the price goes down, I would have taken a long reward, but that didn't occur in this. Okay, now let's see about this. Now there is a clear cut in this scenario. You can see that after this movement we have occurred a second movement, and now as you can see that this is a perfect double top. Now after this is bar 24, is also a signal bar, but below that, if those who have sold this position has to cover up till about this, so the bears will get trapped at this. So generally it is a rule that it is better to sell below low 2, and you should not sell below low 1. But if you have taken a trade at on taking this as a signal bar and this as an entry bar, you might have got out at 10 rupees. Now this is a very good example to understand that we should never enter in a running candle. As you can see that if this consider bar 26 as a signal bar, okay, price didn't went below 26. Now in the second, let's say this is the signal bar, the price didn't went below 27, 28 bar low didn't go below 27. Same as you can see that till 38 bar, okay, the price didn't went below this, okay. So these are all 26, 27, 28, 29, all are signal bars, but their low has been reserved, their low has not been hit. And as you can see that this wick is just above the high of this bar 19. So I missed this trade, I didn't took the trade, I should have taken the trade, I should have traded below 30 and I should have waited, but I could have stopped out at break even. I couldn't have made the profit because my target is to go above. So even if I have taken this trade, my stop loss would have hit at break even. Now so this is the scenario, this move. So I was talking about that this counter trend, I think this might be a 20 to 25 rupees upside trend, and you can generally I used to do, for if I could have entered long, my stop loss will be below 23, but my experience is that we should never ever try to judge this movement. So we should never try to judge the movement from 23 to 30 because this is a counter trend, and the probability of taking the price on this level is very low, okay. Now even let's try to understand this situation. Now we can see that the price tries to bend down, this is till bar 15 and we went up to bar 19, then bar 23, and as you can see that bar 33 just went below bar 23 and made a bull bar, that is an overlapping bar. This, you can say this is bullish engulfing. Even